Okay, I'm just recording the video as well, okay, so that
Yeah.
you can even watch it later.
Yeah.
Okay, so see, so we are starting with equity valuations now. Okay, now this is one of the easiest subject because it is more like a repetition of level 1 equities and FSA.
Okay.
Okay, equities and FSA combination. 80 percentage, I would say 70-80 percentage, it is all repetitions, and hardly
Okay.
there will be 20 percentage, which is again not very tough as such. It is just again more logical. It is a continuation of that logic, whatever we have seen in equities. Equities level 1 last
Okay.
part sums, the
Yeah.
last chapter sums,
Yeah. Yeah.
in equities, those kind of thing only you will find, plus FSA's uh, you know FSA's topics also you will find. Okay, so now this equity valuations here, intrinsic value. So basically, what is intrinsic value? Intrinsic value is basically the actual value of the company, irrespective of whatever be the market value, because
Yeah.
not necessary that the market value will be equal to the intrinsic value. Ideally, it should be, but will it be? Not
No.
necessary. Okay, so the market value might be higher than the intrinsic value. The market value might be lower than the intrinsic value also. Okay,
Yeah.
so based on that, an equation has been put up over here. So intrinsic value of the analyst. Okay, so intrinsic value of the analyst minus price is equal to intrinsic value of actual intrinsic value minus price plus intrinsic value of the analyst minus intrinsic value, actual intrinsic value. It looks like little bit scary kind of formula, but it is very easy only. Okay,
Okay.
intrinsic value of the actual intrinsic value. Okay, how to understand this? All you have to do is um, take, keep it like an example. It will be easy. Intrinsic value of an analyst and the price. So you
Okay.
think that analyst is very positive. So he says the actual price is 100 rupees. He says it should be 125.
Ah.
Okay. Now when he says 125, quite possible that the actual intrinsic value might be only 110, because
Okay.
he was optimistic about the company.
Ah.
Okay, so that means this difference of 25 comprised of the
10.
actual one. Okay,
Ah.
plus uh, analyst is what,
125.
125 minus actual is
110.
110. So this is the exaggeration
Ah.
part, and this is the actual part. Okay.
Okay. Okay. Okay. Should be equal.
Yeah.
Right and left side
Yeah.
both.
So he said like it will go up by 25. He is right to this extent.
Ah.
Okay. And this is kind of his exaggeration.
Ah.
The actual one and his exaggeration.
The error basically.
Error. Yeah, correct. You can think like that. Error. This is the
Yeah.
error. Okay. So that's why it's an easy equation only. Okay.
Okay.
Then going concern, liquidation value. This all you want to ask any questions here?
Uh, what is going concern assumption?
That is, it is assumed that your company is going to be lasting forever. When you start your company, the
Ah.
assumption is it is going to be there forever.
Okay.
Okay. Then liquidation value is what in case if you want to wind up,
Ah.
then that becomes liquidation value. Okay.
Okay.
Fair market value is market value,
Ah.
and
Invest
investments value is the value of a stock to a particular buyer.
buyer.
Okay. So for a particular buyer, what is the value?
Ah.
Okay. Then valuation. These are all very self-reading, easy topics only. Okay. Reading the market, projecting the value of corporate actions. Okay.
Okay.
Uh, yeah. You want explanation on anything here? Corporate mergers, acquisitions, divestitures means demerger or selling a part of the company. Management buyout. that management themselves, they are buying the
Yeah.
company, like Bharat Pay. Management is taking over the company. Okay.
No, it's all good. It's all
Yeah. Then this we have done in level 1 also, but it is there in level 2 as well. The 5 elements of industry
yeah,
structure as developed by Professor Michael Porter. So
yeah.
this is, Michael Porter's
Industry
uh,
analysis.
analysis. Yeah. So 5 points.
Yeah.
First of all, number one, uh, threat of new entrants in the industry. So when you are analyzing a company, these are the 5 points that he is recommending.
Okay.
Check if new entrants into the industry is easy or tough.
Yeah.
If it is tough, then it is a good company that you are planning to invest in. Okay. Because you don't want any new competitors to keep popping in, right?
Yeah.
Then threat of substitutes, how much the substitutes are going to be a threat for this company. Okay.
Yeah.
So say for example, uh, you if you think about examples, it will even be easier. So threat of new entrants, say for example, I'm investing in some FMCG
Whole.
company,
Okay.
thinking that it is making good profit, but then
Uh,
tomorrow anytime I should be ready to accept the fact that new entrants will come into the market.
uh,
Okay. uh, Similarly, if it is something where new entrants will not come into the market, imagine something like where license is required,
mining
or
industry.
already huge market share the particular
Yeah.
company has got, then
Yeah.
it becomes little difficult. Say for example, Geo. Now in
Uh,
this kind of businesses, license is required, huge capital is required, so new entrants will be little tougher.
uh,
Okay. Then threat of substitutes. So substitutes, how much are you worried about the substitutes? If there are too many substitutes, say for example, if people do not have any substitute, then obviously if you raise the price also, they will come to you only.
yeah.
But if there are substitutes, that means if you raise the price, they have the ability to go back to your competitor. Say for
Yeah.
example, um, substitutes means, if one car is too expensive, I can go to the substitutes of another car which is similar one kind of thing, or mobile. If Oppo and let's say, what is that, Oppo and Vivo, so they are more or less substitutes. Okay, they are more or less substitutes. So if one is raising the price, I will go to the other one. Okay,
Yeah.
that is substitutes products. Then bargaining power of buyers, how much buyers have the bargaining power? Like for example, in internet we don't have any bargaining power. So
Yes.
whatever Jio and Airtel are saying, we have to accept it.
Uh,
That is, so that means such business is good.
mm,
Okay, investments perspective. Okay, bargaining power of suppliers. So if suppliers have a good bargaining power, uh, then uh, then the company will not get raw materials
uh,
easily, because the raw materials price will go up.
uh,
Okay, if bargaining power of supplier is weak, that means the company can get the uh, raw materials very cheaply.
yeah.
Okay, so that is the difference. Okay, otherwise what will happen, the raw materials price will go up, the supplier will keep increasing the price, and then you will not be able to get the profits then.
Yeah.
Okay. And the third one, bargaining power, is, can you pass on, even if that happens, can you pass on the price to the buyer? That is the question. If you have the ability to pass on the price to the buyer, then your business will sustain.
Mm,
Otherwise, what will happen? Otherwise, the business, the investor will go to your substitutes.
yeah.
Rivalry among existing competitors. Okay, say for example, nowadays, in this food delivery app, there is a lot of rivalry.
Yeah.
So if there is a lot of rivalry, then hardly anybody is going to be surviving. Okay,
Mm,
so nobody is going to make huge profits over there. Okay, like Instamart, and then Zepto, and then
Blinkit and all.
Blinkit, and then Zomato. So all these are coming as what, delivery app now,
Yeah.
right? Okay. Okay. Then there are three generic strategies a company can employ in order to compete and generate profits. So three generic strategies. So what are those? Number one, you be the cost leader. Cost leader
Yeah.
doesn't mean keeping the highest price. Cost leader means keeping the lowest price. Okay. So lowest cost producer, cost leader. Okay. So people should come to you because you are keeping the lowest cost.
Uh,
Okay. Or else people should come to you. You are keeping because your product is very different, like iPhone.
Yeah.
The price is very high, but the product, the brand is very different. Okay,
Yeah.
and then focus is a mixture of both. Both means cost as well as product, like Samsung kind of thing. You can take as
Yeah.
the example.
Got it.
Okay. Then investigating the issues associated with the accuracy and detail of your firm's disclosure is often referred to as quality. Okay, quality of financial statements. So quality means what? Quality as in if they are trying to, if they do window dressing, or if they keep changing the accounting methods.
Yeah.
Okay, or if the inventory, LIFO to FIFO, FIFO to LIFO, if they keep changing, that shows the quality of financial statement is not good. Accelerating, or this shows quality is not good if they are accelerating, if they are over depreciating, or over
Uh,
depreciating, or not depreciating properly. All that impacts the quality. Okay, reclassifying gains and non-operating income, expense recognition. So how are they doing all these things? Through this we will come to know the quality of the financial statements.
uh,
Okay, all these bases are there in, again, level 1 only, right?
yeah.
We have studied in FSA, like how
Yeah.
over depreciation they will do, or they will capitalize it instead of expensing to increase the profits. Those things
Mm.
are all possible. Okay,
Mm.
this shows all quality of the financial statement. Off balance sheet issues. Off balance sheet means what? Like swaps. The liability will not be shown in the balance sheet.
Swaps is a liability.
Yeah, reason being, swaps is a liability in the sense, in swaps what happens? You are agreeing to pay fixed rate, and you are
Yeah.
agreeing to receive floating.
Yeah.
Okay, or let's say you are agreeing to, so let's say so when you are agreeing to receive floating,
Uh,
that means you can incur losses also, na, there. Pay fixed, receive floating.
yeah. Yeah.
Now
Yeah.
how much losses will happen, you have no idea, so you cannot show it on the balance
But
sheet.
what if it's other way around?
Possible.
We are
Profit is also
receiving. Yeah.
possible, but off balance sheet, no, there is no clarity how
Uh,
much money you are going to get or lose.
uh,
Okay, so that is one example. Or imagine you have to pay floating rate.
yeah.
You have agreed to pay floating rate. So these are all off balance sheet liabilities, which becomes a little tougher. Then leases can be structured as operating. So leases are, let's say the leases that is supposed to be financing, you have
Uh,
kept it as operating. So these are all some accounting, manipulations. All those things are all possible. See, they have given the examples here.
Got
Poor earning qualities. Related party transaction they will do. Related means what? Related means you are a board of member of one company, and you are
uh,
running your own another company. So there can be related party transactions. Na?
uh,
You are the owner of one company, and you have acquired the shares of, you are holding 20% shares of another company.
uh,
Now there can be some influence between your company and another company, and you can, because of influence, you can show some fake sales.
yeah.
So that is all related party transactions. Just go through this, see you want explanation on anything.
Okay. What is consulting service uh, provided by audit firms? Like, why is it a
Hmm.
warning sign?
Okay. Excessive loans, poor, uh, warning signs of poor quality, poor earnings quality,
Yeah.
disputes
Sixth
and
point.
changes in auditors. Yeah, yeah, yeah. Consulting services provided by an audit firm, executive compensation tied to profitability, declining margins or market share. Um, okay, warning signs of poor earnings quality and risk of negative earning surprises include consulting services. Uh, See, consulting services provided by per se it is not a problem, but otherwise how that can create problem is provided by an audit firm. Uh, um,
It can say that they are in a problem and then audit firm is providing a consulting to get them out of that problem like that.
it can what?
It can depict that that company is into a problem and that consulting firm is helping them out of the problem
It
like
can
that.
depict that the company is going to face problem and the company and
And the consulting firm is helping them out to get out of the problem
ha.
like that.
Okay, yeah. See, what happens is consulting services provided by the uh, auditing firm. Uh, just imagine there have been cases where accounting fraud has happened, where uh, where the auditors, neglected the scams or else accounting fraud that was happening. You take Byju's, um, where Deloitte, I think Deloitte or Price Water Cooper House, they were the auditing company. So, in any accounting fraud that happens, their auditing firm, how come auditing firm is unaware about all those things? So that means auditing firm, the consulting services provided by an auditing firm
Yeah.
uh, is not a very genuine one.
Okay.
Okay, so you can, instead of writing consulting services provided by an auditing firm, they should have written something like biased consulting services or something,
Uh,
not a genuine one, genuine, not a genuine consulting services. So that can reduce the quality. Or else, what happens? See, when auditing firms are there, their job is to make sure that always to, if you are standing here and if you can stretch this accounting till here,
uh,
or consulting's job is to bring you till here so that you don't cross the line.
uh,
You understood what I'm trying to say here? Like, for example, you are saving some tax through some borrowing loan and all that thing.
uh,
Now they will make you to borrow even more. You come to this level so that your borrowing is more and more, so that your uh, uh, tax payment comes down.
okay.
So in this case, later on it can create some problems later on, in case later on if the
If
company
you are
is not
not able
performing
to,
well.
yeah,
Yeah, so such consulting services which are meant to, they are following the rules, but then finally the company's earning quality is getting impacted, no?
yeah,
So genuinely, if they say, see, their, what is their job? See, this is the job. What will they say if a company is taking less borrowing? What will they
uh,
say? That, they will they will ask them to bring it up.
uh,
But later on, that only will become the problem for poor earning quality then.
uh,
So all those, uh, and then further it will lead to other, they only advise, no, about, you do this thing and increase the depreciation,
yeah,
or do this thing and decrease the depreciation, or else you capitalize, show your
uh,
transactions like this and you capitalize it.
uh,
Most of the time, even they are also a part of all the game that is happening around, that
got
can
it.
lead to poor earning quality. Okay.
Uh, got it.
Absolute valuation model means you are not comparing with any other company, which is what dividend discount model.
Okay. But today's time, DDM is not used, no? It is an outdated model, no?
No, nothing like that. uh, See, it is you. The question is, why do you say it is an outdated one?
The course that I am doing, he said that DDM is not used at industry level.
But why that you should cross question? Na? Why? What is wrong
Uh,
in that model?
he said that no, like he said that he'll answer it when he'll start DDM. When he'll start he'll start teaching DDM.
Okay, all right. See, no, nothing like that. Nothing like that. See, you will find some differences between what I am speaking and
Okay.
what you are learning there. that, as I said, what he is teaching is what he believes is right. What I have to teach is what is there in CFA, and CFA is research all.
Okay.
Okay, so that is his art. Okay, now this is also highly used only, but then it depends upon for which company. See, you cannot apply all models in one company.
Okay.
Okay, so different models, different companies. Now,
Ah.
for example, nowadays there are many new age tech companies and all those things are there.
Yeah.
Startup, all that. I cannot apply dividend discount model over there.
Because they are
But
they're not giving any dividend.
yeah, they are not giving dividend, or their dividends structure will change. They are
Yeah.
growing company. But if it is a matured company
Ah.
like Infosys, TCS, which is giving constant. If you see Wipro, it gives
Yeah.
constant dividend.
Okay.
So companies like Wipro, I can easily apply. It
Yeah.
gives constant dividend. So constant as in, I can easily predict that how much dividend is going to pay me next time.
Yeah.
So in such cases, then dividend discount model works. So that means, and now the question is, are you interested in such large cap company? For example, I'm not interested in any large cap company.
Ah.
I personally don't like large cap companies. But then that doesn't mean it is bad,
Ah.
because I'm a heavy risk taker. So
Ah.
for me, dividend discount model does not work.
Ah.
But I cannot come out and say like others, dividend discount model is a wastage. Like as I said, large cap does not work for me because I'm a risk taker.
Ah.
I want to get into all mid cap and small cap only.
Ah.
But then while teaching, you never know, your nature might be for large cap only.
Okay.
Then for you, dividend discount model makes more sense.
Hmm. Got it.
Okay. So dividend discount model, one, yeah, dividend discount model is one.
Ah.
Then relative valuation is example, relative. You are comparing with the firm.
Ah.
So all PE, all this comparison,
Yeah.
price to earnings. Okay, relatively, it will tell you relatively overvalued or undervalued.
Ah.
Okay. Then describe sum of the parts valuation and conglomerate discount. Sum of the parts valuation means this you will use for conglomerate companies. Like, one company is into multiple products or multiple sectors.
Ah.
So multiple products or multiple sectors. Okay. So say for example, Tata is into so many companies,
Yeah.
Tata Investments, let's say, or
Ah.
Geo. So
Ah.
they are into so many, or Reliance. How do I value Reliance now? Reliance is into oil to, Reliance Fresh and Reliance Trend and Reliance Geo. So many companies it into.
Ah.
So what will I do? I will sum all the parts. Okay, that means one part I will value, and then I will add up all together. But
Ah.
theoretically, that should be equal to the entire value of the company.
Okay.
But practically, what will happen is if I add up all, it will not match to the entire value, because the entire company will be normally always trading at a discount by around
Okay.
20% or so. This you
Okay.
can check anywhere, any company conglomerate, it will be trading at discount only. Okay.
Okay.
Why it will be trading at discount is because practically, if you are owning one, see, there is one company which is into four other companies.
Ah.
Now, practically, what is the probability of liquidating all this company and this company getting all the cash in its hand? It's very low,
Ah.
very low. So for that reason, and also this company might not have control in all those companies.
Okay.
It is holding shares. That doesn't mean it is holding majority shares. There is no guarantee.
Ah.
So for that reason, because it does not have control on all the subsidiaries also, the market will not value this company very highly. It will be giving some discount to it. That means it is trading at the lower rate.
Okay.
Okay. So here, that's why it is conglomerate discount. Okay. So why conglomerate discount? Internal capital inefficiency, endogenous factor, research measurement errors.
Ah.
Internal capital inefficiency. That means you never know, this company might be investing in a loss-making company also. This is a loss-making
Ah.
company.
Ah.
That means money is going into loss making. That is the
Ah.
reason why ITC was never valued properly, because it was into tobacco company which was
Ah.
making a lot of profit, but it was also into hotels which was giving them only losses.
Ah. And
Okay,
that's why they demerged
that's they
the.
merged. Yes, that
Yeah.
means they were, see, whatever profit they were making from tobacco, they were again spending it on hotels, and that was like wastage for them.
Same is going on with Tata Motors also. Their
Huh.
commercial
Yeah,
vehicles is not working and like
yeah,
that.
yeah. So any conglomerate, this kind of problems will happen because all
Uh,
the business may not be doing very well, na?
yeah.
Okay, so three explanations for conglomerate discounts: internal capital inefficiency, endogenous factors. For example, the company may have pursued unrelated business. So one management cannot manage these two. Skills are different, right?
Huh.
Like one Mukesh Ambani cannot be skilled in every business that he is doing.
Yeah.
Okay, so that's why market is not going to value it highly.
Okay.
Unrelated business. Then research measurement errors. Some hypothesize means some general statement that conglomerate discount do not exist, but rather it is a result of incorrect measurement. So that is also a hypothesis that
Ah.
maybe whatever, see, quite possible that I have done some mistakes in all this valuation. So
Okay.
automatically my parent company's valuation should come down.
Ah. Got.
Okay. These module quiz you just read peacefully and then attempt it. Okay, and then if you face any problem, you let me know. Okay,
Okay, sir.
because all these are easy only. I know if there is anything difficult or sounds anything that I myself will do it, but I'm
Okay.
expecting you to read properly and then do. Okay, you should read this key concepts also. Even these are all good. First you read properly the entire readings, then
Ah.
do the read the key concepts and do the module quiz. Okay,
Okay.
now dividend discount, discounted dividend valuation. Okay, yeah, dividend discount model only. Now this is just a replica of what we did in level 1.
Okay.
Okay, so dividends are appropriate as a measure of cash flows in the following cases. The company has a history of dividend payments. The dividend policy is clear and related to the earnings of the firm, and perspective is that of your minority shareholder. Okay.
Ah.
Now you see this one. This is an interesting one. See, just go through this question. Based on the financial information on Eastern Consolidated Inc. based in the following table, determine whether or not a dividend discount model is the appropriate model to value Eastern Consolidated common stock. Okay, see this one. 2018, 19, 20, 21, 22. Earning per share. Dividend is constant amount. What do you think?
Uh. Yeah, it is. Yeah, we can use dividend discount model because the dividend is constant. No?
Yeah, no, we should not.
Why?
Because constant in the sense in terms of ratios. See, because the earnings are going up, but the company is not paying dividends
Okay.
properly.
Huh.
So it has to match proportionately. Say, for
Okay.
example, constant rate they are giving. Let's
Huh.
say what is now 1.25 of
Okay.
5.
Yeah.
Just
Yeah.
check
Yeah. Yeah.
that percentage if they are giving every year, some percentage of the earnings.
Huh.
Then based on that, you can value. Or even full if they are giving 100% if they are giving, that is the best one then.
25%.
Okay. So what, yeah. So if they are giving proportional, then accordingly you have to take it. Okay.
Huh.
But here, because there is the dividend amount you can predict, but the ratio is not matching
Huh.
with the
Huh.
earnings.
Huh.
Okay. So here it is not the right way.
Huh.
The dividend discount is not appropriate.
Got it. Got it. Got it. So their rate should be constant, not the value.
Ha. Yeah, correct. Okay. Now what you do, you just try to later on Google and try to find out such companies. You check in screener, see
Huh.
whether or you ask ChatGPT also,
Huh.
and then see if there are any companies where I can apply dividend discount model where the dividend per share is proportional to the EPS and find out some companies. It will give you some companies. Then you cross check in screener whether it is matching or not. Fine. Okay. So you take this as the homework. Okay. You do and let me know. Okay. Because then you will be able to connect it practically. Okay.
Like the dividend discount model is appropriate for
See
which companies?
which kind of companies
Yeah.
you ask. It will
Huh.
give you some names. Which kind of means give me the
List of those
list of
companies.
some companies in India where I can use listed companies name where I can use dividend discount model.
Huh.
Okay. And then you cross check in screener
Huh.
whether the ratio is matching or not. And then you
Huh.
can further filter some companies where you can use dividend discount model.
Okay.
Okay. Then free cash flow to the firm. Now this is, I'll just repeat what we did in level 1 stuff. Free cash flow to the firm. Okay. That table I have to tell you now all. Free cash flow. So free cash flow to the firm. So I did like this 4 varieties you can
Huh.
categorize. Free cash flow to the firm. Um,
Based on
so
CFO, based on
net income.
net income, based on
Uh,
EBIT and based on EBITDA.
yeah. So I'll write here free cash flow to the firm. Free cash. So first is income statement. Right. This is sales or revenue minus cost of goods sold. Then you get gross profit. Then sales general administration expenses. Then EBITDA. Then minus depreciation, minus EBIT, minus interest, earning before tax, minus tax, earning after tax, which is net income or net profit.
Huh.
Or okay. Now from here, when I look back, I want only cash transactions. So net
Yeah.
income uh, to the firm. When I say firm, I'm including equity plus bond, both
Yeah.
bondholder together. So when I go in the reverse direction, tax is fine, interest is fine, depreciation.
You have to
Acha,
add.
interest I have paid, but
Yeah.
I don't want to pay because both are same guys only. So that
Huh.
means it is there within the family. So it is not going out because whom am I paying in this interest? To the bondholder only.
Yeah.
And bondholder is with me only. So that means it is there within the family.
Yeah.
So that means this money is not out. So plus interest into
Huh.
1 minus
Tax.
tax. Okay, tax adjusted
Yeah.
interest. Then minus I have deducted depreciation. So plus depreciation.
Huh.
Right? These are the free cash to me.
Yeah.
Rest is all fine. Now it has to be futuristic. That means in the next cycle, how much money still further I need? I need
Yeah.
money for working capital
Working
investments
capital and
and
fixed
fixed
capital.
capital investments. Okay, then it will give me free cash flow to the firm. Okay, this is one way. Now suppose uh, okay. Now suppose instead of net income, the story begins from
Huh.
EBIT. That means EBIT is given in the question.
Huh.
Okay. Now from EBIT, that means interest is there with us only, earning before interest and tax. So we are not making this problem now here.
We'll
Okay,
add
EBIT.
everything except interest. Like we'll do the
EBIT.
same except
So
interest.
we don't have to add back interest because interest
Yeah.
is still there with us. So I will do plus only depreciation I have deducted, which is
Yeah.
a non-cash item. That's why I'm adding back depreciation because I want free cash transactions only all.
Yeah.
So I'm adding back that depreciation because that depreciation is still there with us. I mean that
Huh.
amount is still there with us.
Huh.
Okay, minus working capital investments,
Minus fixed charge.
minus fixed capital. So free cash flow to the firm. Okay.
Oh,
Then next one, suppose instead of EBIT, EBITDA is given.
yeah. So we'll just deduct working capital and fixed capital.
So when EBITDA, I will deduct working capital, investments, and fixed capital.
Huh.
But is this enough? This is not right. Okay. Why? Because why this is not right? Because let me prove it with some numbers. See, for example, let's take some numbers over here.
Huh.
Let's say uh, 1000 is sales, cost of goods sold is 500, gross profit is 500, this is 250, EBITDA, this is 250.
Oh,
Let's say depreciation is this is 250. Depreciation is, let's say, 125. So EBIT is 125. Interest is, let's say, 20. Earning before tax is 100. Tax is 30. Okay, and my net income is
70.
70. Okay, see now, net income is 70. Interest is 25. So 25 into 1 minus tax is, acha, how much is this interest? Interest tax
1
is 30
minus
percentage.
30%.
30 percentage tax. Just
Yeah.
calculate this. 25 into 1
So
minus
70% into 25.
hmm,
17.5.
so 17.5. Working capital and fixed capital is not given anywhere, so we
Yeah.
will just take on our own. So let's say minus 10 and minus 20.
Yeah.
Now you calculate.
Sir, we have not taken depreciation.
Acha, okay, depreciation is 125
Yeah.
minus 125.
Add
I mean,
na?
add, yeah, 125, yeah. Mm, mm.
182.5.
Okay, now a bit. So now let me check this way also. EBIT is 125. Depreciation is 125. Working capital is minus 10, minus 20. Check if it is coming to 182.5.
125 plus 125 minus 10 minus 20. No, it's 220.
Not matching. Uh, EBIT is 125. Okay, depreciation is 125. Hmm. Something gone wrong in calculations. Uh, just add this once again. 70 plus.
70
I'll
plus
also
17.5
I'll
plus
also calculate.
125 plus, no, sorry, minus 10 minus 20. 182.5.
70 percentage of 17.5 plus 70. Depreciation 125. minus 30, 182.5. Depreciation interest is not paid. There is a mistake. This should be EBIT into, after EBIT, see, I have to pay, anyways, I have to pay tax na, from EBIT
Yeah.
into 1 minus tax. So it
Yeah.
should be, I have to pay tax.
Yeah, so into 70%, if I do 125 into 70%, so I'm
Correct.
getting 87.5.
Mm-hmm.
Then plus
Into
125
1
minus
minus
10
30
minus
percentage.
20. Yeah, 182.5.
Yeah. Okay. How much is this? 70 percentage of
87.5. That same 70 plus 17.5, 18.87.5. Both.
these two will come here. Okay, so it will
Yeah,
match
182.5.
182.5. The next one, EBITDA. Even here also I'm going to pay tax.
Yeah.
Okay,
So
so now
250.
EBITDA, this time it should not match. Okay, there is a reason, I'll tell you. EBITDA is what? 250 here.
250.
250 into 1 minus 30 percentage is how
7,
much?
175.
175.
Minus
Working
10
capital minus 10
minus
minus
20.
20.
It's 145 is the answer.
145. So what is the
Yeah,
difference coming? 145. 182.5 minus 145.
37.5.
So why that 37.5 is coming? Because see, I have EBITDA and I'm paying taxes on that one. So it is okay. I'll just write all these numbers. I think. See, this is EBITDA. EBITDA is okay. EBITDA into 1 minus tax.
Uh,
Okay. I'll write separately here. See, this is EBITDA. Then minus EBIT, minus depreciation. Then EBIT. Then minus interest. Earning before tax minus tax. Net income. Now EBITDA that I took was 250.
250.
Okay, so 250, 125, 125, 25, 100, 30,
30. 70.
70. Okay, now suppose if there is no depreciation, then what would have happened? It would have been 250.
Yeah.
Depreciation would have been 0.
Uh,
This would have been 250.
yeah.
A bit. Interest.
Yeah. Will add.
Okay. Interest is not the concern over here. Okay.
Okay.
So, okay, let me take it as it is. Okay. Interest I'm paying. Then check how much it comes to 225.
Right. Yeah.
Tax, just take 30% of
30%.
225.
67.5.
So you reduce it.
157.5.
So now what is the difference? See now we are not focusing on this net income, we are focusing on this tax.
Huh.
Now in tax, you see, because I have not uh, because here I have not included depreciation, my tax has gone up by what amount? I'm paying more tax.
Almost double. More than double.
How much is that? That is 37.5.
37.5.
How is that 37.5 coming? Because that means now I'm paying more tax to the government, but that is
Huh.
wrong, because actual accounting says what? I will be reducing depreciation and I'm supposed to
Yeah.
pay only 30. But
Yeah.
if I go with this calculation, I am paying 37.5, which is wrong.
Yeah.
So uh, so that 37.5 is over exaggerated taxation I'm giving. I have paid
Yeah.
more. Okay, so this is what I'm doing here. From EBITDA directly I'm paying taxes. So when I pay directly, I'm paying taxes without showing depreciation.
Uh,
So when I don't show depreciation, my tax goes up highly.
uh,
By how much? This
37.5.
37.5 is nothing but 30% of depreciation. Just calculate this.
Yeah.
So that means this much I have overshown.
Yeah.
Okay, this is 37.5, right?
Yeah.
37.5. Okay, so that means because I am paying over tax now, so what should I do?
Yeah.
I should add back that depreciation into tax. Depreciation into tax is what? 37.5.
Uh,
I will add back that. Understood?
yeah.
Now, if you add, it will come to 182.5.
Yeah.
Is it okay? Understood this one now?
Got it. Got it. Got it.
Okay. Then next one
CFO.
is another way, CFO. Okay. Now cash flow
CFO
from operations,
plus
that also done in level 1. Cash
plus
flow from
interest minus fixed
operations.
cash.
Yeah, in cash flow from operations, we have already taken care of working capital, cash
Working
flow
capital.
from operations.
Yeah.
So I need to reduce fixed capital investments.
Yeah.
Okay, and then what do I have to do? Working capital is taken care of. Then
Add
interest is
interest.
already deducted. So I will add back because interest is a part of the family now.
Yeah.
Bondholder is a part. So interest, tax adjusted interest. So that means now CFO we have not. Acha, CFO also I can do like this. CFO is a combination
Net
of
interest plus working
net
capital plus
interest, um,
plus net income. Net
depreciation,
income plus working capital. Working
and
capital. Huh?
this working capital.
Yeah.
Add this all together. That will be my CFO.
Hmm.
That means 70 plus 125 minus
125 minus 10.
10. How much is that coming to?
Uh, 70 plus 125. 185.
185. So 185 is my CFO.
Yeah.
Interest into 1 minus tax is 17.5.
17.5.
17.5 I
So,
will add,
yeah.
and then
202.5.
minus 20 is the
20.
fixed. Calculate all this.
182.5. 182.5.
So yeah, understood.
Yeah.
Okay, fine. So yeah, so this is it. Okay, this you can practice later at home. Okay,
Yeah.
so this numbers with numbers, if you know, it will build confidence in you then. Okay, so this is free cash flow
Yeah.
to the firm. Then residual income is something new that you are going to learn, but it is all again just the extension of foundation. It is easy only.
Okay.
So this is the last, I think, last part, either last or second last reading is residual income, where we will be dealing with this, uh,
Okay.
you know, there are quite a few sums, so that time you will understand better. Okay.
Okay.
Basically, residual income, see, there are many ways, right, that we have learned in level 1. So how do you value equity valuation? What we
Asset
have
based,
seen is
multiplier, free cash
one
flow.
is dividend discount, cash
Yeah,
flow models.
cash flow models,
Now, under that, we have dividend discount model, then free
free cash
cash
flow.
flow model. Okay.
Yeah,
Then next one is
multiplier.
relative valuation. Yeah, relative valuation or else multiplier, price to earning,
EV by EBITDA,
yeah, or price to book ratio. Then third one is
asset based,
uh,
asset based.
yeah, so which is asset based.
Yeah,
Asset based, before that EV multiple.
that goes into multiplier only, na?
Similar only. Yeah.
Yeah, same.
Okay. Yeah. Similar only. But this is more about acquiring the company. This is from
Okay,
minority shareholders perspective.
okay.
Okay. Then next one is asset based valuation.
Ah,
Okay.
okay.
Asset based means where you will calculate the net worth of the company, NAV,
Yeah.
net asset value. So this is what we saw in level 1. Now, you know, we are adding one more, residual income. Now, what is residual income? Residual income means uh, now when should we use this kind of model? Say for example, there is a company which is not paying dividend. Okay, so
Okay.
I cannot use this method. Okay, then free cash flow. Now the problem is this company is making a lot of profit. So can I use free cash flow? No, I cannot use. Why? Because it doesn't keep any cash free. Because it is reinvesting. It is growing fast. So it is reinvesting. So there is no free cash also. Then what to do? You understood the problem? Hello.
Yes, sir. Yes, sir.
Okay. So
Yeah.
free cash flow also will not work. Then what will I do? Of course, P ratio I can use in any company. But then if I want to see the fundamentals, as in like absolute valuation perspective, then residual valuation income I can use. Residual value means what? Wherein after one simple, wherein I will think that after paying to the, see, I have got net profit, correct? Net income.
Yeah.
Net income. Now from this net income, I will minus one simple example. There are multiple formulas for calculating, but
Okay.
here just to help you to understand what is residual income, so that when you read, you can keep that in mind, so that it becomes easier. Minus, now from net income, what I will do is I will minus equity charge. Now, what is equity charge? Equity charge means minus equity capital into required rate of return in equity. That means how much they were supposed to required
Cost of equity.
rate of return. Yeah, cost of equity, correct.
Okay.
Required rate of return or cost of equity. So that part, that means assuming that I'm paying off to them also, what is the left out cash, which I might have
Okay.
reinvested and I don't have any cash left out. But
Ah,
those all will be considered as my residual income. So from the net income, I will reduce this equity charge, which is equity capital into cost
okay.
of capital.
Okay.
Cost of equity capital into cost of equity.
Yeah.
Okay. And so remaining left out, say for example, 100 rupees is my net income, or in our case, it is 70 rupees in our
Ah,
example, right?
ah,
It was the net income here when we
ah.
calculated. Net income was 70 rupees.
Yeah.
Now imagine our equity is, no, equity capital is maybe like 200 rupees,
Ah.
and cost of equity is
12%.
let's say, yeah, 12 percentage. So how much it comes to?
Uh, 24.
24. So 70 minus 24 you do.
46.
this is my residual income.
Okay.
On this basis, I will value the company. Okay. So
Yeah.
this will, when by the time we finish this entire subject, you will get a fair view, like when to use which model and all those things.
Okay.
See here, this one. They have given like this for all models, which is very good here. When to use.
Hmm.
Firms that have negative free cash flow for the foreseeable future. Why? All money has been utilized. So now what to do? Due to capital demands, all utilized.
Huh.
But their financial firms are with financial reporting transparent and high quality earnings.
Huh.
So you can go for residual income model. Is it okay?
Yeah.
Okay. Rest is when you read, you will be able to understand. See this one now. This is pure one period dividend discount model. Just go through this question and see.
Yeah.
Okay. You are able to understand. See,
Yeah.
Best Buy shares are expected to pay dividend at the end of the year 1.25. So end of the year 1.25.
Yes.
And they estimates the required rate of return to be 8%, and the expected price at the end of the year to be. Acha, so this is the dividend, and this is the dividend, and the price is expected to be 28.
28.
The current price is 26.
Yeah.
Currently it is 26. Calculate the value of the shares today and determine whether the best buy is overvalued, undervalued, or properly valued
Yeah.
using dividend discount, one period dividend discount. So this is the amount I'm receiving, and the required rate of return is 8%. Just
Yeah.
calculate this.
25.9.
25.9.
2. 2.
So that means this is overvalued, 26.
Hmm. Huh? We have not added the dividend to it, sir.
So you should add, no? See, that's why I circled
Acha,
it.
ha, okay, okay, okay. Sorry. I did not add a dividend to it. So 27.0.
Hmm. So it is undervalued one.
Undervalue.
It's simple one.
Yeah.
2-period dividend discount model. Just go through this now.
Yeah.
Okay.
Yeah.
Now, Machines Unlimited shares are expected to pay dividend of 1.1 Canadian dollar and 1.72 at the end of each of the next 2 years.
Yeah.
So this is 1 and this is 2. 1.55
1.55, 1.7.
Canadian dollar and 1.72
7.
at the end of the next 2 years, respectively. The investor expects the price of the shares at the end of the year 2-year holding period to be 42.
42. Yeah.
Okay. The investor required rate of return is 14%. So you
40.
have to discount with 14%
Yeah.
and calculate. So 1 plus 14% raised to 1 keep it in store 1, 1 plus 14% raised to 2. And then find out the value. Or you can go to cash flow. There
Okay.
you keep this CF0 as 0 and CF1 as 1.55 and CF2 as this number.
CF0 as 0.
CF1 as 1.55 and CF2 you add these two, 1.72 plus 42.
1.72 plus 42. Okay.
Okay, and then
43.72. Okay.
calculate NPV. It will ask for interest, key in
14.
14.
35.
35 exactly.
Yeah.
35. That
Okay.
is the value.
Okay. Okay. Okay.
Okay. Then multi-period dividend discount model. Just go through this now.
We have to do the same CF
Same,
function.
same. Yeah.
But we had this in level 1, na?
Yeah, it is ditto all level 1 only. You yourself can do
Yeah.
many sums here in this one. It's all ditto level 1. See, reliable motor shares are expected to pay dividend of 1.5. Expected to pay 1.5, 1.6, 1.75. 1, 2, 3. 1.5, 1.6, and 1.75. Okay. The investor expects the price of the shares at the end of this 3-year holding period to be 54. The investor's required return is 15%. Again, you can do using cash flow also.
Yeah. I did it
But
39.170.
okay. $39.170.
170. Yeah.
Yeah, that's right.
Yeah.
Then this is yeah. So Gordon growth model is also there.
Yeah.
Then 2-stage, all this we have done. H model is new here, but again nothing difficult. Okay. 2-stage means the growth rate is changing. 3-stage means it is changing multiple times. Okay.
Can we do 2-stage ones?
All these examples are there as we move ahead.
Yeah.
Okay. Then Gordon growth model. Okay. Just go through this now.
Down under. Okay. Okay, so first through CAPM I'll find the current price. Huh?
See, paid initial now paid 1.80.
Yeah.
Okay. Australian dollars. An analyst has examined the financial statement and historical dividend policy of Down Under and expect that the firm's dividend will grow at a constant rate of 3.5 indefinitely.
Yeah.
Okay, so 1 plus 3.5% calculate.
1 plus 3.5
5% of and then into 1.80.
1.863.
1.863. Okay, now the formula Gordon growth model is equal to what? P0 is equal to D1 by R minus G. So D1 divided by R minus G. R is what?
Risk-free rate is 4%.
Acha, R is not given directly, so we have to find out. So when
But
we
they
see
have given
beta and
risk-free rate,
risk-free
na?
rate, yeah, so we will have to find out R. So R
R
is
and
equal to,
risk-free rate is same, na?
no, R here means required rate of return.
Sorry.
Risk-free plus beta into RM minus RF. So, uh, okay, risk-free rate, beta is given.
10 is required rate of return. Is 10.
Acha, this is the expected return of the market
Yeah,
portfolio. Okay. So market is 8% minus
4%.
risk-free is 4%. Beta is 1.5.
1.5. 10.
Just calculate 10%.
Yeah.
So
So
this is divided by 10% minus indefinite growth, right? So
3.5.
3.5%. Now you solve this.
Uh, 0.2866. 28.66.
Okay, fine.
Yeah.
Okay. All right. So we'll do one thing. We'll stop now here.
Okay.
Okay. And so far what you do is you can start reading this. Okay.
Yeah.
Right from the beginning you start reading this, it will be interesting only because all these something which you have already done before.
Yeah.
Okay. And in the meanwhile, I'll just convert all these videos into YouTube and then I'll just send it to you. Okay.
Okay.
So now in some time. Fine. I'll
Yeah.
stop now here.
Okay.
Okay. Okay. Bye.